The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, we kicked off the month of November on Friday, wrapped up the week, kind of a mixed bag. We started fairly strong across the grains and oilseeds, then we gave up some of that strength in soybeans and bean oil, and we kind of tried to fight our way back into the close and really just ultimately ended up with a mixed bag on the day on Friday. Corn trying to hold firm, wheat, a little bit of mixed action there. Mixed action in livestock, plenty of things to watch on the macro front. So let's try to sum it all up and let's have a conversation with Ted Seifert from Zaner Ag Hedge. He joins us for our market analysis today. Ted, good to talk with you again, my friend. How are you?
Hey, man, I'm doing great. Always a pleasure, Jesse. Thanks for having me on.
Well, as I mentioned, kind of a mixed bag. Hard for me to sum up Friday's trade. You know, you get end of the month, beginning of the month, end of the week. Just I feel like a lot of things at play, maybe some hedge pressure, some farmers selling took part, midday on Friday after we got some good strength. I mean, I don't know. All in all, I would call it kind of a mixed bag across the board, Ted.
Yeah, it really feels like markets are fairly indecisive at the moment. I think we're trying to balance the short term versus the long term, and also balance the individual market fundamentals versus the overall macro fundamentals that we will learn a lot more about next week. So yeah, I mean, just a kind of a very sideways week for corn. Although corn does act like it might want to try to break out to the upside. It very much acts like it needs to break out one way or the other. It's not 100% sure which, but it keeps trying that 100-day moving average at 414 and a half. Got above it briefly there Friday. Really didn't back off of it. And you know what, Jesse, I gotta say, I'm getting more and more friendly corn. I think we've talked about it a couple of times. I think the longer term picture for corn is pretty decent. I mean, we see a lot of demand happening. Another sale on Friday, big sale on Friday, 780,000 metric tons to Mexico. Those numbers keep coming in. You do wonder a little bit if there is some pre-election buying, maybe some concern about if Trump gets elected, how he's going to treat exports with any country. I mean, we know that, he wants to do some things for the trade with China. Again, relive the or maybe trade war round 2, something like that. But I think other countries are a little nervous about it also. So you wonder if this is front-loaded buying, or is this actually going to keep up, right? And if it does, then I think you got to say, the corn balance sheet continues to get a little bit tighter. It's not in a bullish standpoint. I mean, we're just under a 2 billion bushel carryover, but 2 billion bushels, and it's not bullish, right? But go back to the Outlook forum back in February, and every report really since then, that carryover has been shrinking, getting to a more reasonable level. And I'm also going to say, Jesse, if we have to have basically a 184 national average yield to get to, again, just under a 2 billion bushel carryover, I'm not sure we planted enough corn last year, or I think we're going to need to see some more corn acres this year. I think somewhere around 92 to 93 million instead of the 90.7 that we planted last year. Because what happens if we have all this demand, but we only come up with a 177 national average yield? All of a sudden, we're looking at a very tight corn balance sheet in that scenario. So I think corn needs to find that acreage. We talk about demand, and we know that exports have looked really good. We continue to see these big flash sales. We know ethanol's done really well. The one thing I'm not hearing a lot of people talking about, though, is pasture and range conditions. 19% good to excellent. That's one of the lowest readings we've had in like 20 years. So you think that corn for feed is going to be a stronger category than maybe what the USDA currently has on their balance sheet too. So really all the categories that you can look at for demand for corn, I think, have a positive lean at the moment. And then again, I think we need more acreage. So, traditionally we say, okay, well, what's the corn bean ratio doing? And is it suggesting more corn acres? And, Yeah, but I don't feel like that by itself can do all that heavy lifting. Um, you look at December 25 corn at 440 perpetually. I mean, it's just, it really seems like it just wants to stick on that 440 level. I don't know
Hmm.
if that's enough to get it done. You think about input costs, you think about interest rates, you think about just the cost of production for corn. It doesn't 440 December corn doesn't really make everybody warm and fuzzy about going in and planting more acres, even if soybean prices were to go a bit lower and that corn bean ratio were to favor corn even more so. I think we're going to need to see that December corn get to, 485, 495, somewhere in that neighborhood to really get those acres. So I think as I look into the end of the calendar year and into spring, I see upside potential for corn. Corn being the leader, maybe soybeans can sort of follow along. Although soybeans need to be careful not to really try to buy acres. I really don't
Hmm.
think beans need to buy acres. When we're looking at a 500 million bushel carryover domestically, but globally, Jesse, and this is the biggest problem for soybeans, the global carryover has gone from just under 100 million bushel or 100 million metric tons to 135 million metric tons in just 2 marketing years. We've got a lot of beans in the world right now, and
Yeah.
so beans have to be careful not to follow too closely with corn. But I do see upside potential for corn as long as we don't have these crazy outside market factors really affecting us. That's the potential fly in the ointment, I think. But without that interfering, I do think there's upside potential for corn. It's just a question of when does that start? Do we start that now? I mean, this is a time of year we talk about post-harvest rallies and things like that. So seasonally, yeah, now could be the time. But I'll also say I really don't think guys have sold as much corn as we typically expect during harvest. I think there's still more bushels yet to get priced.
Hmm.
So I could see us maybe waiting to see what the election brings, maybe waiting to see what the Fed does with interest rates. Um, but sometime I think sooner than later, I think corn has that upside potential, and especially like I said, when you look into the end of the calendar year and into spring.
I was going to say to that point with thinking about maybe not enough corn bushels priced here. I mean, from a risk management standpoint, if we're a little friendly corn here,
Yeah.
should we be locking in some floors, taking advantage of some carries and some basis and things like that? I mean, should we be looking at some of that now, or should we be waiting a little bit to see if we have some more upside potential, Ted?
Yeah. Oh, well, I mean, I think there's bushels that just need to get sold now. I don't think for some of those bushels, I don't think you have the luxury of just waiting. If you do, maybe you do. I mean, look, we built a lot of storage when prices were really high. That was one
Mhm.
of the wisest investment choices that I think a lot of guys made. So yeah, that being said, I think there's bushels that need to get sold, and when you do that, I think there's ways of looking at reopening upside potential. I am kind of keen on that right now for corn specifically, not so much for soybeans. But like go out into like say March, for example, and like a $445 call spread, I think is really attractive for me. That way you're managing your downside risk because again things can happen for corn to head lower yet. That rosy demand picture we just talked about, that could change quickly if there's global economic issues. A lot of people worried about the Chinese economy. The Chinese are worried about the Chinese economy with the stimulus packages that they've announced. And stimulus in historically is not necessarily uh, an easy fix or a silver bullet, right? I mean that I don't know, that actually concerns me about China, and with the Chinese economy having such a large impact on the overall global economy, there's concern. So like again, managing downside risk I think is a great idea. But I do like the upside potential for the reasons we just talked about in the corn. I think we could have that strength in the spring. So call spreads. The other thing you can do is if you sold enough cash, you don't need to, right? I mean, owning some puts to protect the downside, sort of a worst case scenario. I like that idea too. I think it just really depends on the individual, where they stand as far as, what their cash sales look like, what they need to do between now and the end of the calendar year. So, I mean, I've been kind of taking that on a case by case basis, but I do like having that upside potential for corn one way or another, whether it's on the cash side or replacing it with some fairly low risk call options.
Ted Seifert with Zaner Ag Hedge is our guest analyst here today on Market Talk. Ted, I'll lean into the soy complex just a little bit more with you too. As I know you brought up the global picture and the elections, and I think a lot of that may be tied together here. Just it seems like there's a lot of bearishness for the soy complex as a whole. Yet we've seen really strong world veg oil values this week. That's kind of been supportive. And so I'm like, okay, I see a few good bright spots, but yet I see a lot of bearishness here. So, I mean, from your perspective, I just feel like soybeans are kind of hovering right below this $10 mark for a while here, barring something crazy. I mean, would you agree?
Yeah, yeah. I'm very curious to see what the USDA does on bean yield, right? If that were to drop, dramatically, that can change the outlook a bit. We've heard a lot of reports that the later harvested, i.e., later planted soybeans, did not do anywhere nearly as good as what the earlier stuff was, and that makes sense. I mean, with all the dryness that we had at the end of the growing season. So I mean, if that's to occur, if you get a 2 bushel drop on that national average yield, that does change things pretty quickly. But short of that, if that doesn't happen, which I'm actually not sure. Jury's out for me, right? I mean, you hear reports both ways, so very curious to see what the USDA does on a November report. Which, by the way, November reports aren't usually a big deal, but I think for soybeans, this one is shaping up to be. But yeah, I mean, that global carryover is the thing that bothers me the most, Jesse. We don't currently have a major concern about Brazil. We started their planting season with some pretty major dryness concerns, but they've caught up on planting very quickly. They're really not even behind anymore. And their weather outlook is pretty decent. I mean, so if there's not a big problem in Brazil, if we don't have a dramatic cut to U.S. yield, it's a very limiting factor for soybeans. And I'll take it back to acreage, right? I mean, soybeans don't have any business trying to own any more acres than what they had last year. We don't need more soybean production, both domestically or in the world. And like you said, veg oils, a lot of strength there. We are excited about new uses for veg oils. Sustainable aviation. It's something that we always go back to when talking about soybeans and wanting to be bullish soybeans. But the thing about that, Jesse, is that one, we're limited by crush capacity right now. We need more infrastructure to really, really ramp up soybean crush to make more soybean oil in order to use that for sustainable aviation. We have tax issues as far as using soybean oil for sustainable aviation right now. Spent or used cooking oil coming from China is preferred, and that's a problem. So that needs to get changed. The infrastructure has to be put in place. And in order for that infrastructure to get put in place, I think the uncomfortable truth that nobody really seems to want to talk about is that these guys need to be offered really strong incentive for that to happen. I.e., you really need to see crush margins at historically high levels for a long period of time for them to say, okay, look, we have this really interesting opportunity. Let's go ahead and spend this massive amount of money that we need to really build this infrastructure up faster and bigger than what we have now. And good crush margins. What that means, Jesse, is that you're going to have low priced soybeans, and you have to have high priced or higher priced products, soybean meal, but really more particularly soybean oil. So that strength in veg oil, while I like it, it does add support to the market, but I think you got to take a step back and realize that this is what's got to happen in order to get that infrastructure built. And strength in soybean oil alone isn't enough to say soybeans need to go sharply higher, because again, you need those strong crush margins. We are limited by crush capacity. We don't typically crush soybeans for soybean oil, and that can be changing, but this is a process. And the fact of the matter is that I really believe that this process has to be uncomfortable for a little bit for the producer, but very comfortable for the end user. And that's the incentive. And again, that's the part that you don't hear talked about as much. You just hear, well, sustainable aviation is coming and this huge demand is coming, and that's great. but to get from point A to point B, that road that we have to travel might not be the most comfortable road for soybean producers.
I do want to ask you about the macro markets and energies. I always like to get your perspective there. And Friday morning's jobs report was very curious. 12,000 jobs net in October, according to that report. And I know we got a Fed meeting coming up here this next week. I mean, your thoughts on that jobs report and just some of the moves we've seen in the macro markets here as of late? Because they're definitely, I think, having an influence on the commodity sector, Ted.
Yeah, 12,000 jobs, right? I mean, that's basically the people that went to work at the Halloween costume stores for the month. Yeah, yeah. Well, it certainly builds a case for the Fed to cut rates again next week. I don't really think they should. I mean, look at the stock market continues to gain strength. We have concerns of inflation popping up again. I don't think cutting rates is the right thing to do, but you get a jobs report that now kind of justifies that a little bit more. So I don't know. If they cut rates, that allows for more inflation potentially. It's obviously bullish for commodities as a whole. It's bullish for energies. It's better as far as, our interest rates are concerned. So, I mean, look, there's a lot of good things that come with cutting rates. I don't think it's the right thing to do, but, I don't know. We'll see. The thing about energies, though, is that we are now getting into this time of year, seasonality, where we see demand start to drop. We travel, road travel is a bit less. We travel for the holidays, but wintertime we don't move around as much. So that seasonal decline in energy prices, that can take some of the steam out of soybean oil and ethanol, things like that. So. Yeah, from a macro perspective, again, energies is a great story longer term. Is it something in the right here, right now? Seasonally, the answer to that is no, not really. But like I said, I mean, we got so much going on between election and interest rates, and what are things going to look like 2 weeks from now, Jesse? And your guess is as good as mine. And I think that's reflected in markets too. I mean, look at corn, very, very sideways for the week. I think we're waiting for some answers before we really do make any decisions on which way to go.
I couldn't agree more. I think there's just so much uncertainty out there in the markets that's kind of got us in limbo to some degree here until we get some concrete answers. And I'd say in the livestock trade too, just to touch on cattle and hogs, I think that's the case there as well. Cattle, though, I'm a little bit concerned with some of the cattle action we've had the last few sessions, whereas hogs are on a rocket ship to the upside here. So that whole protein complex has been an interesting one to watch here to close out the month of October and get into November, Ted.
Yeah. And, if you think about it, the really amazing strength that we've seen in hogs versus it was a bad week for cattle. I mean, look, it's nice that we bounced off the lows on Friday. We went down and tested the 200-day moving average and bounced off of that. That's good. So there's a little bit of a positive takeaway at the end of the week. It could have been worse, I guess, is the takeaway. But if you look at it as a whole, it kind of makes sense if we have these concerns about the economy post-election, right? Because, are people going to continue to pay for the higher priced beef, or are they going to look at cheaper alternatives, i.e. pork? So the idea that pork demand could strengthen into the winter months and into the spring, I think is very much reflected on what's happening with the hogs market. And then the concern about what our domestic demand is, and it's a domestic market, what our demand is going to be for beef going forward. I'm also going to say that, we were due for a bit of a correction in the cattle complex. I'm not so sure that this is it. Like, I'm not so sure if we can say, okay, well, that was fun and now we're going sharply lower. But we needed this sort of correction. We needed to kind of cleanse the market a little bit, money flow, so on and so forth. So yeah, I'm curious. Again, so many question marks about the economy, what happens with the election, what happens post-election, what happens with interest rates. I think we just got to get through next week. And if we can do that, and we are feeling like the economy hasn't come to an end, we're still all right, then I do wonder if cattle can get back up towards those highs again. We've got a lot of weight up front. We've had this ongoing supply concern, but weights are sort of offsetting that for the moment. But we can pun intended, chew through that weight pretty quickly if we're seeing that demand happening at the butcher's counter. So yeah, let's get through next week. And I think we could potentially see a recovery when we realize that, okay, now this uncertainty is behind us. The world's not coming to an end. People are still going to eat. That demand is going to be there. I really think that will.
Ted, if folks want to have a conversation with you about their marketing plan and more at Zaner Ag Hedge, how could they get in touch with you?
Absolutely. You can reach me directly at 312-277-0113. Aside from that, you can find us on the web at www.zaner, that's ZANER.com. You can read a bit about us. You can also sign up for our afternoon commentary. I do about a 5 to 7 minute quick recap on the markets, just a few thoughts. And then if you're on the X or Twitter, or formerly Twitter, X Twitter, whatever, I am at the Ted Spread, and I like to have some fun on there.
Always good to have a conversation. Appreciate the insight. Ted Seifert with Zaner Ag Hedge. Thanks for joining us on Market Talk. Have a good one. We'll talk to you again soon.
You do the same, Jesse. Thanks for having me. Take care, buddy.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.